All right, so get this. China's stock market, specifically the A-shares market, just shot up 30%.
Whoa, 30%.
Yeah, in just 2 weeks.
That's
I
insane.
know, right? It's crazy. It's all thanks to this massive economic stimulus package they just rolled out.
Yeah, everyone's talking about it. But here's the thing, right?
Yeah.
Is this a sign of like real, actual growth? Or are we looking at, one of those bubbles that's about to pop?
It's the million-dollar question, right? You got to look
Yes.
under the hood.
Yeah, we have to kind of go beyond just those headlines and really dive deeper into, you know, whether this stimulus can actually fix some of China's, deeper underlying economic problems.
Yeah, because it's kind of like, you try to supercharge a car with a sputtering engine. It's like
Exactly.
a temporary boost, but it's not going to solve the, the root issue.
Yeah, and that's where things get really interesting, I think, because, think about it. How often do you see a market jump 30%
Yeah,
in 2 weeks without some serious intervention?
right.
This rally is heavily influenced by policy, not just organic market forces.
Okay, so we've got government intervention, a skyrocketing stock market.
Right.
This is starting to sound a bit familiar, isn't it?
It does, actually. It kind of reminds me of
Yeah.
Japan's lost decade.
Ah,
There's some, interesting parallels there, and there's a lot we can learn, I think, from their experience,
okay.
particularly from the two policy-driven bull markets
Mm-hmm.
that they kind of went through, one that failed and one that ultimately succeeded.
Oh, wow. Okay.
Yeah.
Japan's lost decade. That's,
Nobody wants to repeat that.
No, definitely not. So tell me more about those bull markets. Like, what happened?
Sure. So, back in 1995, 5 years into their economic slump, Japan kind of decided, okay, we're going to throw this massive stimulus package
Mm-hmm.
at the problem, hoping to like jumpstart the economy.
Sounds familiar.
Right? It does sound familiar.
Yeah.
At first, it seemed like it was working.
Okay.
Japan's GDP shot up the Nikkei stock index,
Yeah.
soared a whopping 60%. But then things took a turn. You see, they hadn't really dealt with the core issue, which was this mountain of debt.
Mm-hmm.
A lot of it held by what economists call zombie corporations.
Okay, zombie corporations. I'm intrigued, but also a little creeped out. What are those exactly?
So imagine companies that are essentially dead,
Okay.
but kept on life support by banks that are just too scared to pull the plug.
Oh, wow.
They're inefficient, unproductive, and they're dragging the whole economy down.
So Japan threw a bunch of money at the problem, but didn't fix the underlying issues. I can see how that wouldn't end well.
Yeah, and it did. It was like a classic case of, short-term sugar rush
Mm.
followed by this long, painful hangover.
Ouch.
So now let's fast forward to 2021.
Okay.
This time, Japan did things differently. Instead of just throwing money at the problem, they focused on market reforms,
Mm-hmm.
forcing companies to, shape up and banks to
Yeah.
finally address those zombie corporations.
So they finally ripped off the Band-Aid and dealt with that infected wound,
Yeah.
so to speak. And what happened? Did it work?
It did, and in a big way. The Nikkei returned to its pre-bubble highs
Wow.
after 30 long years.
That's incredible.
Yeah, it just shows that for a real sustainable recovery,
Yeah.
addressing those structural issues is key.
Mm.
It's not just about those temporary stimulus measures.
Yeah.
You can't just paper over the cracks.
No.
Got to fix the foundation.
So the takeaway here is fixing the underlying problems is way more important than just pumping money into the system for a quick boost.
Exactly.
Mm-hmm.
And that's where things get really interesting. When we kind of bring it back to our deep dive today and look at China, we see some striking similarities to Japan's lost decade,
Okay.
particularly with these two big issues that they're facing.
Okay, lay it on me. What are these big looming issues?
Well, the first one is debt.
Okay.
China's local governments are sitting on a mountain of it. Over $9 trillion, to be precise.
$9 trillion.
Yeah, and it's a ticking time bomb.
Mm.
Their growth model relied heavily on land sales and loans,
Mm-hmm.
which isn't a sustainable strategy in the long run.
So it's like they built their economic house on a foundation of sand.
You could say that.
Yeah.
And just like Japan's corporate debt, this mountain of local government debt
Right.
is a huge drag on the Chinese economy, limiting their ability to invest in things that could drive real sustainable growth.
Okay, so debt issue number one. What's the other big challenge China's facing?
They're state-owned enterprises, or SOEs.
Okay.
They're often inefficient, they benefit from preferential treatment, and they crowd out the more dynamic private sector.
Mm-hmm. SOEs are those kind of like China's version of Japan's zombie corporations?
They are quite similar in some ways.
Okay.
And for China to really thrive, They need to reform these SOEs, make them more competitive,
Mm-hmm.
and create a level playing field for the private sector.
All right, so we've got these two major issues, debt and inefficient SOEs that are holding China back. Now, the big question
Yeah.
is their current stimulus plan actually addressing these problems, or are they just kicking the can down the road?
That is the million-dollar question.
It,
And to answer that, we need to delve into the details of China's stimulus package.
let's do it.
What exactly are they doing, and will it be enough?
All right, let's unpack the stimulus package and see what we can learn. Here's where it gets really interesting.
You know, it's interesting if you look back at those policy-driven bull markets in China,
Uh,
they kind of tend to unfold in three phases.
mm-hmm.
And I think understanding those phases can actually give us a little bit of insight into, whether this stimulus is going to stick.
Okay.
The first phase is kind of like a sentiment reversal,
Mhm.
right? That initial jolt of stimulus, it triggers optimism, and investors start piling into the market.
So that 30% surge in the A-shares market, that was phase one.
Exactly. Pure market psychology.
Got it.
But sentiment alone is fickle. It can shift as quickly as it surged.
Right.
The key to a sustained rally is whether China can move into phase two,
Okay.
which we call policy confirmation.
Policy confirmation. So that means the government needs to double down, keep those stimulus measures coming.
Exactly. Show that they're serious about this.
Okay.
And investors will be watching very closely for any signal that Beijing is committed to this course. Maybe even adding more fuel to the fire.
Which explains why everyone's hanging on to every announcement coming out of China,
Right.
trying to read the tea leaves and figure out what's next.
You got it.
Okay.
But even if we get those signals and the market keeps climbing, there's still that crucial third phase,
Okay.
the actual economic turnaround.
Right.
This is where the rubber meets the road.
Mm-hmm.
And it all hinges on whether China can achieve genuine, sustained growth,
Huh.
not just a stimulus-fueled sugar rush.
Right, because a truly sustainable bull market has to be built on solid economic fundamentals, not just government intervention. Otherwise, it's like building a castle on a foundation of clouds.
Exactly. And that kind of brings us back to those structural issues we talked about earlier, the mountain of debt and the inefficient SOEs. If China doesn't address these root problems, their long-term growth prospects will remain shaky,
Yeah.
regardless of how much stimulus they pump in.
So even if this rally keeps going for a while, it's not necessarily smooth sailing ahead. There's still a lot that could go wrong.
Absolutely.
Yeah.
And here's where things get really interesting for investors watching China.
Okay.
This stimulus package includes a wide range of measures,
Mm-hmm.
but there's one glaring gap.
Okay.
There's no real focus on tackling that debt crisis or overhauling those SOEs.
So they're throwing a bunch of darts at the dartboard, hoping something sticks, but not actually aiming for the bullseye.
That's a good way to put it.
Yeah.
They're addressing some symptoms, but not the root causes.
Right.
And while the stimulus might deliver a temporary boost to growth, it's unlikely to be a long-term solution
Mm-hmm.
unless they tackle the debt and SOE problems head on.
Right.
They could be setting themselves up for a repeat of Japan's 1995 mistake.
A short-lived boom, followed by a painful bust.
Mm.
Not exactly a scenario investors want to see. So should investors be steering clear of the Chinese market altogether?
Well, it depends. With any investment, it all comes down to your risk tolerance and your investment goals.
Right. Some people might be more comfortable with a little volatility if it means the potential for higher returns.
Exactly.
So for those with a higher risk appetite, are there any potential opportunities here?
There might be. For example, certain sectors are likely to benefit more from the stimulus than others.
Okay.
Infrastructure projects, for instance,
Hmm.
tend to get a big boost from government spending.
Mm-hmm.
So companies involved in construction, transportation, and related industries,
Yeah.
they might see their earnings jump,
Yeah.
things like that.
Makes sense. Government spending on infrastructure is a classic way to stimulate an economy. What other sectors might benefit?
Well, consumer discretionary spending could also pick up if the stimulus puts more money in people's pockets. So companies that sell goods and services that people buy when they have extra cash,
Mm-hmm.
things like restaurants, entertainment, travel,
Yeah.
they could get a lift.
So even with all the uncertainty surrounding China's economic outlook, there are some potential bright spots for savvy investors who know where to look.
There you go.
But it sounds like doing your homework is crucial here.
Absolutely.
Yeah.
This isn't a time to blindly buy into any company with a China label.
Right.
It's about carefully selecting companies that are genuinely well-positioned to capitalize on the stimulus and have a solid long-term outlook.
So investors need to be discerning, look beyond the hype, and understand the real drivers of growth in specific sectors.
Exactly.
Now let's talk about China's recent emphasis on stability over rapid growth. Does this mean they're turning their back on growth altogether?
Not necessarily. I think they're still aiming for growth, just a more sustainable,
Okay.
less volatile kind. Think of it less like slamming on the brakes
Okay.
and more like easing off the accelerator.
So it's less about screeching to a halt and more about finding a smoother, more controlled pace?
Precisely.
No.
They've learned from experience
Mm-hmm.
that unbridled growth can lead to bubbles and instability,
Mm-hmm.
and they're deliberately trying to avoid repeating those mistakes.
Okay.
And I think this shift towards prioritizing stability
Mm.
is a major development, not just for China, but for the entire global economy.
Whoa. Okay, now we're talking about global impact. Help
Yeah.
me understand that. How does China's focus on stability ripple outwards to the rest of the world?
Well, for decades, the world has been looking at China as this like economic powerhouse, right? This unstoppable engine of growth, driving demand for everything,
Mm-hmm.
from oil and copper to smartphones and cars.
It's true. China's been a huge factor in global growth, for sure. But if they shift to a slower, more controlled pace,
Right.
it kind of changes the equation for everyone.
So paint a picture for me. What are the implications of a China that's prioritizing stability over, breakneck speed? Okay, well, first, think about all those global supply chains that are so intertwined with China.
Mm.
If demand cools down there, it could impact businesses all over the world.
Makes sense. Less demand from China means less business for companies supplying them with
Huh?
raw materials, components, all those things that go into, made in China products.
Exactly. And it could also impact countries that export heavily to China,
Right.
places like those in Southeast Asia or Africa.
Right.
Their economies could feel the squeeze if China's buying less.
Okay, so there's a potential domino effect on global trade. What else should we be thinking about?
Geopolitics is another big piece of the puzzle.
Okay.
China's economic strength has really fueled its global ambitions,
Mm-hmm.
and its military spending has been rising steadily. I mean, we've seen them becoming more assertive internationally.
Yeah, China's definitely been flexing its muscles on the world stage more and more.
Exactly. But if their economic growth slows, it could impact their ability to maintain that level of geopolitical assertiveness.
Yeah.
Might force them to kind of reassess their priorities.
Interesting. So a slower growing China might actually be a less assertive China on the world stage. That's not something you hear every day.
Yeah, it's a possibility worth considering. I mean, predicting geopolitics is like trying to predict the weather,
Right.
but it's a factor we can't ignore.
Okay, so we've got potential impacts on global trade and geopolitics. What about like the average person? How might this shift in China's economic strategy affect their lives, directly?
Well, there are a few potential scenarios. One possibility is that a slower growing China could actually lead to lower inflation globally.
Oh, I think a lot of people around the world struggling with rising prices right now would love to hear that.
Absolutely.
Hmm.
And it could also mean less competition for resources,
Mm-hmm.
which could be good news for consumers in other countries.
Okay, lower inflation, less competition for resources. Any other ways this might play out for consumers?
Well, on the flip side, a less dynamic Chinese economy could mean fewer innovative products and technologies coming from China.
That's an interesting point.
Yeah, if their focus is on stability rather than, pushing boundaries, it might put a damper on innovation,
Right.
which could impact consumers who have become accustomed to a constant flow of new gadgets and services from China.
So what you're saying is this shift in China's economic strategy is a big deal,
Mm-hmm.
not just for China itself,
Right.
but for the whole world.
Oh, yeah.
It's like a giant ship changing course, and everyone else needs to adjust.
That's a great way to put it. And it raises some really important questions about, the future of globalization and how the balance of power might shift on the world stage.
Well, I think we've given our listeners a lot to think about today. It's been a fascinating deep dive into a really complex issue.
Absolutely.
Yeah.
And it's a story that's still unfolding. We'll need to keep watching closely to see how it all plays out.
To wrap things up, China's stimulus package has generated a lot of buzz.
Yeah, a lot of buzz.
But it's important to remember there's no quick fix for their underlying economic challenges.
Definitely not.
And their new focus on stability over rapid growth has major implications,
Mhm.
not just for China, but for the entire global economy.
Absolutely. It's a dynamic situation that we'll, continue to explore in future deep dives.
Yeah.
But for now, thanks for joining us and keep asking those big questions.
See you next time.